This is Saurabh Jain. So I would like to introduce our speaker for today. So Padmaja needs no introduction in the startup ecosystem. Everybody knows her. So Indian Angel Network was the first angel network in India, and it is one of the biggest angel networks in India. So today I would be asking her a lot of questions for the wannabe startup founders and people who are looking for funding. So the first question which I would like to ask Padmaja would be, who is an angel investor and why he or she is needed for a successful startup story? So Padmaja, welcome to the show. And you are one of the most famous angel investors in India. So I think no better person than you to answer this question.
Thank you. First of all, thank you for having me, Saurabh. Delighted to join. Can you hear me?
Yes, yes, I can hear you. So I will repeat the question once again. Who is an angel investor and why he or she is required in a successful startup story?
Okay. So that's an interesting question, Saurabh, and probably that two words encompasses the whole concept of angel investing. If I split that, there are two words. There is investor, which means that somebody who puts in money and expects a return, right? So these are obviously people who put in money and expect a return. And then you have the angel part, right? And that's interesting because angels are typically either related to religion or where they do something angelic. So for a startup, when it starts in its very, very early stage, it is the most vulnerable on the one hand, but on the other hand, just by being defined as a startup, it has no track record. It has no collaterals. It has nothing to mortgage. It is just largely two people standing on the ground and starting out. Now, therefore, where do they get the money to start up? They then go to these angels because actually there is no bank that can invest. There is no large private equity fund that can invest. So where do they go? They go to these angels who actually do a very angelic action by investing in them. And these angels are basically riding the same risk like a startup founder is. So they are investing in the share capital of the company, which means they're taking the same risk. They are saying that if your startup succeeds, we will succeed and we will get returns on our investment. But if your startup does not succeed, we are ready to write it off.
So
Okay,
what are the
obviously.
typical returns which you expect from any startup?
Well, clearly for taking the kind of risk that angels take because of a very early stage, they clearly want more than market returns. Okay, so that is very, very clear. But typically they're hungry for more, like most investors. So they would like very high IRRs or investment returns uh, on their capital. Because remember that they will be investing in at least 10 to 15 startups, if not more. I myself have invested in close to 80 plus startups. Okay. Now, out of those 10 or 15, assume at least 20% or 25% will fail. So that angel investor, another 10, another 25-30% will do break even, just about float on the top of the water. There'll be another 10-15% will do better than break even. So it's only 20% of the investments which will actually make bumper money, and those 20% have to make money for not only those companies in which they give the bumper, but for the entire portfolio. It has to not only return the entire money for the entire portfolio, but also make more than market returns. So actually the companies that succeed, yes, in some ways are working for the companies that are not succeeding.
Okay. So over to the next question. So what is an angel network? So many people know about angels in general, but angel network is something which you brought to India. So and also story of the Indian angel network. We can combine these two questions.
Sure. Maybe I should give the story of the IN because it will then also explain the network. So when we started, there was no angel investing as a concept in this country. But I was working a lot and engaged with Thai, and a lot of entrepreneurs had started to send us business plans because, again, remember, they were not being able to raise money from elsewhere, right? So they needed 2 crores or 3 crores and they didn't know where to go. So we started getting a lot of those business plans. And we started looking at them and shortlisting them and saying, okay, here are 3 or 4 or 5 which look plausible. Okay. Now there were 2 ways to do it. We were 5 co-founders. Okay, Raman Roy, Saurabh Srivastav, Mohit Goyal, Pradeep Gupta, Lok Mittal, and myself. We were 6 of us as co-founders. We said, okay, one of us takes each investment and puts in money and works with it, which didn't make sense to us. We said, why don't we put together, let's say 3 out of the 5 and put in a little bit of money in each of them so that the company gets its money, but we have risk mitigated ourselves by putting some money in each of them. That is the basis of the genesis of a group of people coming together. Okay, and that's how IN started. Then, as we started growing, we realized that around the world there were other angel groups as well. But one of the classic things, or one of the common things we saw, they were very locally and very geography specific. So we had Cambridge Ventures, then we had Oxford Ventures, we had London Ventures, we had Westminster Ventures. We had, it didn't make sense to us. And, we have a problem because we are such a large country with such a large population. We invariably think scale, right? So you're from Paytm, right, Saurabh? So when you started your proposition of Paytm, I'm sure the company thought that what works in Delhi should also work in Chennai. Yes. Right? So we think scale, we think diversity, we think accessibility, and therefore we think technology, right? So similarly, when we did IEN, we said, why the hell are we why are we geography specific? Why are we not geography leveraged? Okay, why can't we leverage geography to scale? Why can't we leverage geography to add value? Okay, and in fact, one of our very first companies, Dhruva, where we had invested $1 million at $1 million valuation, which is now pushing to become $1 billion and go IPO. Okay, the real first breakthrough customer was NASA. Okay, because we had investors in the US who could help. So what I'm trying to say is geography leveraged became a big item. And that got us to think about, instead of having an angel group, to have a network or a platform bringing angels together from different parts of the world, as well as therefore then be able to invest in different parts of the world. But then create mechanisms by which we have integrity, both financial and otherwise. We have real-time information. We have transparency, all the good things of governance that we talk about. We brought that in through a platform. And now for the last few years, we've enabled all of this through technology. So if there's an investor who's committing, he will be able to see it somebody else will be able to see, okay, he's invested and how much has he invested. We brought it down to that level of transparency.
What is the general level of investment you make in a company?
So, Saurabh, what we've now done with about 500 investors who are actively investing with us from 12 countries, we also have a fund, a SEBI registered fund, okay, which sits together, which is another 60 million, 55, 60 million fund. Now, with these two, what we've created is the single largest horizontal platform for seed and early stage investing. So an entrepreneur who comes to us can raise from 25 lakhs to 50 crores on a single platform, right? So he can start, as he builds his business, he can just move from one room to the other, one bucket to the other. And I think this is what we are trying to do, to build for early stage companies, one of the biggest issues is fundraising. It can take 7 to 8 to 9 months. In fact, I joke with a lot of my VC friends to say it's easier to conceive and deliver a baby by the time you decide to invest. The idea is that how do you crunch that time so that the company is able to get the money as it grows. And how do you bring this network of 500 people and then the network's network of many thousands of people to help the company? Because that makes a much better quality, faster growing companies that we're seeing. And how do I endorse that? Okay, how do I know that I'm creating a very high quality, high growth portfolio of companies? If you look at any marquee VC investor in this country, it has invested behind us, right? So if you look at a Sequoia, you look at a Kalari, you look at Paytm itself, right? You look at InfoEdge, you look at IDG or Chirate, you look at Access, everybody is invested. We have investments from Tencent, Tiger, Alibaba, Tanaya. We've got people from Credit Suisse from their headquarters in the US, DHL from Germany, Apcoa from Germany, all invested in our companies, which tells you that the quality of companies that we are doing is very high. And therefore, our investors have got cash exits every single year from at least 3 companies for the past 11 years. Okay, and that has pushed our IRR into the early 40s, reduced our failure rate to about 15 to 18%, which is exceptional in the world of angel investing globally. And I know that because I'm also the co-chair of Global Business Angel Network. So there's a lot of data that comes through.
That's great. So shifting gears to like how should people come to you? So how should an early stage startup founder approach you? So say if somebody is there and they have some idea, so first thing they have in mind is that they should get investment. So do you invest at the idea stage, or do they need to show you something? And also, how can they approach you? Like this is one of the biggest grievances of new startup founders, is that they are not able to approach the angel investors, and they always ask me also, like, how should we approach, or can you forward our profile to some investor? So you can tell about that.
So I think one way of approaching angels is, of course, writing into angels that you may know, which most of the entrepreneurs do have an issue. The second is write into people like us, Indian Angel Network. If you go to our website, there are contacts, there's ways of submitting your plan. That's a good way, because these angel networks typically know the investors. They know who's interested in which space, who's based where. So it makes more sense. You know, most of that early accessibility problem is solved by the groups like IAN. Third is, events like this. I would suggest everybody to engage, because what happens is you know who's doing what, you have an idea of who's investing where. So typically angels invest 3 to 4 crores per company, right, per round. But people like us invest from 25 lakhs to 50 crores. So suddenly you have a much better view of who to go to depending on where you are on your website. So those are things. Today, I think entrepreneurs should be complaining a little less about accessibility. Google has done a good work of making us accessible. So if you research us for angel investors, it will show up the top angel groups. It will show up IN on the top. Reach out to us. And the last is by networking and getting people to refer your business plans to people even like us. It does help, honestly. So networking, I think, is very important. And you, of course, as rainmakers from Paytm, etc., you have all the connects considering who you are. So that's another way of doing it. Speak to our portfolio companies, they will connect you to us. So there are lots of ways to do it. You are not.
Do you believe in an elevator pitch?
Yeah, I do. I think it's very important for us to get clarity about the founder, to say how clear is he about his proposition and plan. So we do, but we don't do what a typical elevator pitch is, to get onto the ground floor and they do it in 2 minutes. We do give time like 15, 20 minutes at least to the entrepreneur, so that he can have a rounded presentation or a pitch, and we have the ability to ask some very early questions, which only provides more clarity than anything else.
And what are the key points you see in a startup and its founding team before investing?
Okay. So I think there are 5 or 6 major points. Number one is, why is the product? What is the product? Okay, the clarity of a product is what's the proposition? Why is it required? Who's going to buy it? Right? That's very, very important. Otherwise, the existence of that product is questioned in some ways. Second is, what is the market size for that product? Who's going to buy it? Is it a high growth? Is it a large market? Is it a high growth market? Is there an ability to really make this a large company? That's very important. And that is dependent on market. Is there clarity on not only competition, but competitive solutions, right? So if one issue is really that you're thirsty and that's a pain point, one point is that you can have Pepsi or Coke, but remember you're competing with water, and that's what I mean by competing solutions. Number 4 is, how are you going to access that customer? That's important. Is it a B2C? Is it a B2B? Is it a B2G? Is it a B2B2C? These are very, very technical questions, but it's not. It's like, are you going to access your customer from a business to business perspective, business to consumer perspective, directly? All of those things have to be clear. And how are you going to price it? Because if you have a product which is very well made, but priced heavily and the customer cannot afford it, it's sincerely a waste of time, right? Because then nobody will buy it as much as they think it's the greatest product on earth. So you have to price it right. I mean, Apple, if you really ask me, has one of the best pricing strategies in the world, right? So that's another piece. The fourth piece is, how are you going to deliver the product? What are the risks to delivery? Have you thought of a little thing about delivery? How are you going to do after sales service if there is that need in the product? How are you going to also monetize that after sales service, or what people call spare parts, right? So those things make it more interesting. But the most critical thing in my mind is the team itself. Is the team got clarity of the domain? Do they understand what they're doing? Do they have passion for what they're doing? Suppose we don't invest, are they still going to do this, which is persistence, right? Are they leaders? Because as the company grows, they are going to be leaders who will build the team. They are going to be leaders who are going to scale the company. Do they have that ability? We do understand, investors do understand that there will be gaps in the team, but that's okay. Are they clear about the gaps? Do they know who they need? What kind of profile they need? And how are they going to keep them engaged? For instance, are the key people going to be part of the ESOP plan, right? We've seen some very good entrepreneurs and businesses which have come to us and says, no, we're not going to give this person ESOP, we're going to make him a co-founder, even though that person may come in 12 months later, right? Because they think that is what is required. And finally, all of this comes across in a financial plan, projections. And projections at a startup level is not really a balance sheet projection, but cash flows. Because balance sheet is irrelevant at this stage of the company. How much cash is required? What's your cash per month requirement? How much revenues are you going to get? What's the gap and how does that flow out? Have you thought of every little thing? I mean, if you know there's going to be a power outage, do you need to buy a generator and an inverter? Have you thought to that level of detail, right? And finally, how do you value your company, right? Are you wanting investors? That's a very big message that comes. Oh, I'm going to give you, I've got zero revenues. I'm going to grow this company over the next 3 years into $1 billion company. So I'm going to give you 1% of the company for 10 crores. It's not going to work. Let's be real, unless it's a real IP or something, and normal execution play, it's not going to work. So think through. It's very important to think through that just as you value your work, your product, what you have built, please value your investors. Because if that, after all that, it can become a very disengaging conversation. If somebody tells me a weird thing like, I'm going to give you 1% of the company at the stage I am, which is really pre-revenue, I'm just thinking, I've really I've already wasted my time.
Mm-hmm.
So I think respect for everybody, yourselves, your team, your mentors, your advisors, your suppliers, but also for people who you're bringing in. As much as you need the money, investors also want to invest in good opportunities and make returns, right? The business of the startup is to build the business that they are in. The business of investors is to invest and get returns. So there is a very equal partnership, and that is required in both ways. And if that trust and chemistry is not there, then you're fighting for minor small things. You need to give way and leverage your investors who bring in much more than just money. And these are the things why I'm going through this in a slightly more detailed fashion, Saurabh, because these things matter. These things, whether the team is mentorable, are they open to good ideas? Yet do they understand that domain enough to say, look, what you've said is fine, but here are the real pieces that we are seeing on the ground. And therefore we will know. A clinical approach, logical approach in debates and discussions will only help, right?
So over to the next question. So I think you have covered a lot of things like what are the key points you look, but are there any things extra which you look in a pitch deck? So specifically that presentation, which is the holy grail. So do you look for any specific things, or like all the points you have just discussed, you see on
So Saurabh, for me, the pitch deck is not the holy grail. Okay. For me, the holy grail is those 2 or 3 founders standing in front of me. Okay. For me, I'm looking for people. I'm investing in people. I'm not investing in a pitch deck, right? How they present, how they convey their passion, how they plan to how they handle the questions, how they answer the detailing, how deep have they gone through thinking, and most important, right? If they have their backs to the wall, will they still do this? And it's a very, very difficult thing what entrepreneurs do. I doff my hat and I have huge respect for them, because actually they are selling 24/7 to everybody, not only to investors and not only customers, right? When they're building their team, they're telling a person, join me. Today I'm a million. I may not be $1 million, but 3 years and you'll be $1 billion. I'll give you share. Join me, but I'm not going to give you market salaries, right? He's selling. He's telling that supplier, right? You're giving everybody 45 days credit, but arey boss, in 3 years time, you will have to build another factory just to sell to me, supply to me, but give me 90 days credit just now. He's selling, right? He's selling to his investors. Sir, today your valuation is not $1 million. You just give what I'm saying. I'm going to make this $1 billion valuation in 3 years. He's selling. He's also selling to his wife or husband or partner.
that is also good.
I'm doing this for you. I'll just go via the office and come and join you at the movies. How many of us have done that? Okay. So this guy is on a total 24/7 into 365 days selling. And that's what we're looking for. कितना कर सकता है यार?
Yeah, I understand that. So this last one, I think, is very relevant because we generally leave the family, and I think they are the most important ingredients in a entrepreneur's life. So next question is, so many startup entrepreneurs are generally confused about the legal agreements, and most startup founders I've seen are techies or designers. They generally don't have much legal knowledge. So can you tell about the legal agreements required by angel investors and VCs in general? So if you can tell a little bit about term sheet and some of the other documents besides term sheet which you make people sign.
So I think there are three main documents. Okay, number one is your term sheet, which is basically nothing legal. It's very, people should read it. It's very easy to read. Okay, there's very little legalese, to be honest. It is basically a document which is documenting the terms agreed between two people. Okay, the terms of investment are, I'm going to give you 2 crores, I'm going to take X percentage of your company, I'm going to get onto the board of your company, these are going to be my rights. That's it. That's what a term sheet is. Okay, you want to accept this, it's open to you for so many days, otherwise it's gone, right? Which is fair, because the investor also wants to look at other opportunities to invest in other companies, right? He doesn't want to lock his money. The company also wants freedom to go and look at other investors for whatever be the reason. So that is one. The second piece is what we call the shareholders agreement. Investors like VCs and angels invest in the shares of the companies. So they're buying shares, right? That's why it's a shareholders agreement. There, the term sheet terms are detailed out in a legal document. Okay. What we do is we have standardized both these documents so that only the customization is this much amount for this much percentage or whatever, right, with the name. So it makes it simpler for the company. We also do one more thing. We also put in some sessions for entrepreneurs who are signing term sheets. We'll bring 4-5 of them because we do so many, right, onto a webinar or a workshop. We earlier used to do workshop, so they understand and they have clarity on it. These are not documents to hoodwink or put something under the table or do anything. No, we want our entrepreneurs to understand what they are signing very clearly. Okay, the third piece is employment agreement. Okay, what we are saying is please sign an employment agreement, because apart from being a shareholder, you're also a full-time executive of the company. I'm not, as an investor. I'm a shareholder, but you are. So we would put in some of the clauses that every corporate puts into an employee, that you have to put all your 100% time here, whatever IP you have is confidential, you will be, this is your package, because the founder will also get some salary or something, right, beyond that. So we put that through an employment agreement. Those are the three documents that you would see in any transaction.
And the changes in the articles of association or memorandum of understanding also based on these.
Yes, so that comes in, that when we put in the money, the memorandum and articles have to change, because there are things that change in terms of the investor coming in. Certain rights will come up. In some cases, to be honest, the authorized capital of the company has to be increased, right? Because when a startup starts the company, he doesn't have money. So uska authorized capital ही बहुत छोटा होता है. Now when we come in, we need more shares to be able to put in the money. So sometimes the authorized capital has to be increased. That all of that goes through the mem and arts.
So we come to the next
question. There is also the diligence that happens. But in startups, how much diligence happens? But if the company has been operational for, let's say, a year, then obviously there's some transactions, some compliance issues that they should have done. All of those are cleaned and vetted, because nobody today wants to invest in a non-compliant company. We are telling our companies very clearly, we want at least a quarterly certificate from you that you are compliant. Because today compliance is a major factor. What it does is not only for us, it disciplines the founder and the company, so that when the next round happens, they get a clean, compliant company. Otherwise, you will have a problem raising the next round.
Okay. So we come to the next question. Can you explain the various rounds of funding? Because generally what I've seen is that most startup founders don't have an idea, like they know there is an angel round and a seed round and then series A, B, C, D, and then you suddenly become unicorn. So there is a lot of confusion for most founders. So can you explain?
So, this series A, B, C, D, I don't go by that definition, to be honest. So the angel round typically is when, so I would go back before the angel round, what we call the triple F round. Okay. which is money put in by friends and families and fools. People like, if I want, my niece is starting a venture, I don't know whether I understand anything, but वो कर रही है तो उसमें पैसे डाल देते हैं. That's family, friends and fools money, right? It's more to support the child more than anything. After that, and in that also many times the entrepreneur puts in money. That's the round. Then comes in external money, which is the first round, external money from angels. Okay, which typically sort of has ranged up to about 6-7 crores. That's the range. Okay. Then you have what has been called pre-seed A round, which typically goes up to about 20-25 crores. Okay.
Of the valuation, 25 crores of the valuation.
No, investment, 20 crores of it. 15-20 crores investment is about pre-seed. And it goes to 30 crores, it moves into Series A sort of thing. So there's no well-defined numbers to each of these. After a company has got about 30 crores of investment, then it's typically looking for about 50, 60, 70 crores. That's when the Series B, right up to 100 crores, is where we look at it as a Series B. And then Series C is 100 crores and above. Okay. What you're talking about a unicorn is not the amount of investment that a company gets in, but unicorn and decacorns and sunicorns are all determined by the valuation of the company, right? So if money is coming in, let's say at $1 billion valuation, it's a unicorn, right? And if a company is raising money and valued at, let's say, somewhere close to $800,000-900,000 million, sorry, then it is a sunicorn, soon to be unicorn. Okay, and if it's going to be 10 billion and above, it becomes decacorn, right? Which is
Paytm sort of a company.
Yeah, thank you. I I wanted you to talk about your own company. So that's how the unicorn word is more on the valuation side. The series word is more defined for the amount of raise. That's the difference.
Oh, okay. So there is a question somebody has asked, that how do you value a company? So many people ask this question also, that first so people have this in mind that they would value the company and investor would just say yes or no. So is that true, or like, is there any process? As a, like, I have done chartered accountancy, so I know there are processes, but as far as I have seen, like especially for the early stage, those processes don't work, because if you go by those processes, you would not get any valuation. So if you can tell about those processes.
See, there are two things that I want to first. So a valuation is almost a session in itself. Okay, but let me try and concise it. So first of all, when a startup is raising money, right? Uh, a valuation on any formula doesn't work like you said. Okay. So I typically said is at an early stage, at a seed stage or at an angel stage, valuation is more art than a science. Okay. And it also means that the investor has to also see the potential value that the company can create. Number one. Okay, and therefore the pitch and by the entrepreneur becomes so important, that today I only have a prototype, but look at the market size, look what I have to do, look what I can do, this is my strategy to build revenues, this is my strategy for customers. All those things go into giving clarity to the other person to say, okay, if he does all of this and let's discount some of it, then this is where he can go. Okay, so that's a little subjective, I understand, but that is really one of the key elements that people don't talk about, which I am talking about. Okay, number two, high quality investors. I mean, I have to humbly say that IN has got that, is they don't really mince about 1%, 2%. That's not what, it's not going to change life. Okay, remember, people who do angel investing, if they lose money on the company, their lifestyle is not going to change. This in some ways is disposable wealth. They are people who are typically have been entrepreneurs themselves. They understand the risk, they understand the hurdles. Okay, so this 1%, 2% fight, I don't see it much. Okay, and it's more to assess how the entrepreneur is thinking. Okay, it actually is more to assess that how is he thinking. Is he more focused on the micro of this or the macro of this? Because you typically want to invest in a company which is thinking big, right? Because then only will you be able to see a big return. So that's how this discussion happens. Third thing is, good quality investors will not take a majority stake in the company. They will take a significant minority, enough to say that yes, this stake is enough to keep me engaged in the company beyond my check writing, right? So I may be writing a check of X amount, but I know that this company has gaps and I can help it. I also have to be motivated as an investor that I'm holding enough of a stake to put in the time, effort, energy, and mind space, right? So that is the third. In fact, Vinod Khosla's formula has been that when he likes a company, he'll probably say, I'm going to take X percentage of the company. Now tell me how much money you want. Right? Because he says, if I don't have this much stake, I don't want to engage. I won't engage. Right? And no investor, believe me, no investor who is seasoned, who's experienced, will underfeed the company. It will give it enough runway. Okay? Because otherwise, the money they put in is also going to go down the drain. Right? And it will never overfeed the company also. Because then it is creating luxury behaviors, which doesn't help the company to grow, right? So I think talking to experienced investors, quality investors, is absolutely critical for companies. Because what happens that when you raise the next round, these are called, sometimes they're called founding investors. Their credibility, brand, their diligence, their valuation is given a lot of credence. Okay, so that's why you hear that, okay, this is a company by IN, we must look at it, right? That's why you hear that this is a company by Chris Gopalakrishnan, we must look at it, right? That is very important. The other piece that entrepreneurs should understand, why investors don't want to go and dilute founders unnecessarily, because for any company to grow, it is execution that matters. And who's going to execute? The founders. They are not going to execute. I'm a lazy, I don't execute, right? So if they dilute the founders and leave them with a very small percentage, then you've converted founders to CEOs and you are running the company. As an investor, instead of being an investor, you're now executive chairman. Nobody wants that, right? And then the next round investor says, oops, the founders are just left with X percentage. This doesn't make it interesting for me, because they're not going to, because when I invest, they will dilute further, right? So then where is the incentive for them and motivation for them to work for me, my money? So I think entrepreneurs need to get in also out of this one dimension valuation piece. Look at the value, look at the credibility, look at the brand, and please have trust in people. Okay? Because if you don't trust me, that I'm going to invest in your company, I'm going to be sitting on the same side of the table, and if you think I'm not going to help you, we should not invest, and you should not take money from them. Okay, because after I put in money, I will work to grow my money, if not anything else. Okay. And it doesn't help me that I'm going to fight with you. It doesn't help me. So look at investors on same side of the table as partners, as value-added partners. Look for people who are going to be a coach, not a captain. You're the captain as a founder.
What is the general dilution, percentage of dilution at every level, every round?
In our system, I can't remember too many companies that have done over 27, 28%. So average has been somewhere between 20, 22. Okay. We've also done companies at 10%, but yeah, they have been much higher revenues.
So broadly 20 to 25%, I can say.
25, 26%, yeah.
Okay. last question which I would be asking, and after that I would be taking the audience questions. So has COVID impacted early stage funding?
Very good question. See, I don't want to give a straight answer because there is no straight answer to it. Okay. What has happened with COVID? Okay. The need for people to do business has not gone away. And the need for investors to do their business of investing and getting returns has not gone away. Right? We both have to exist and we have to drive the economy in some ways. Right? What has changed is customer behavior. Right? You and I are still working, but we're working from home. So what has changed? The need for office real estate has diluted, but the need for an office desk at home has increased, right? So customer behavior has changed. So I'm just giving a simple example to make my point, right? So if I get a venture which says, I'm going to optimize commercial space for your office, I'm going to say, do I need it? Right? But if I get a company like Wooden Street, which talks about the fact that I'm going to create furniture for you, which is office furniture at home, which you can do A, B, C, D in different ways, that's going to interest me. So I think the opportunities have changed. The market has not. Okay. Startups are required. In fact, ever more, I would say more than ever. Right? Because of two reasons. One, they're the most nimble and agile to quickly innovate and create products and solutions for the new normal. Secondly, which is very important, which very few people think, that old industries and corporates have suddenly said, "Arey, hum to digital nahi gaye. I'm still on the ground." Many of them have called and said, "Connect me to startups which can go digital and take me digital." Look at the market and look at the customer there for a startup. Right? So, hence, startup investing has not gone down per se, but has it gone down in terms of certain propositions, certain sectors? Yes. I mean, if you look at jewelry, it's gone down. Unless you're buying jewelry for gold, that's a different issue. It's gone down. How many of us are really going out? Right? So, and if you look at health foods, it has gone up, right? The market is skewed, the consumer behavior is skewed. So that is very important. The second piece, what has increased is today the runway for companies has increased. So companies have to raise enough for 3 years, 2.5 to 3 years, right? Because we don't know when the next round will come. Why? Because globally, it has been declared that there is because of the pandemic, there is a recession. Global recession has been declared. That means liquidity in the world around is going to get impacted, if not already, right? So to raise the next round is going to take longer and more effort. So the companies can't die because of lack of funding. So that has also happened.
So I will be taking audience questions. Before that, just I would like to share a few things about Paytm's product for startups. So Paytm Built for India is giving a Paytm payment gateway plan for startups where we are not charging anything till 1 lakh rupees of transaction value. So any startup which wants this plan, they can write to me. I will share my email address in the chat box. So you can write to me. My team can give you this free payment gateway plan. And we try to help the startups. And I feel in the early stages, every penny saved is important. So this is an important plan. Another thing which I would like to share would be about our mini apps program. So Paytm has started a mini app program. So basically, many people were reaching out to me over time that we want our tie up with Paytm. We want our offerings on Paytm. So Paytm has started this formal program called Mini Apps program, where we are giving integration facility to mobile website and PWAs, progressive web apps. So you can have your icon on the Paytm main Paytm app, and for that you would have to do some technical integration with us. and you will get access to our 140 million monthly active users. So you can write an email to me if you want to join this program. This is for B2C startup, business to consumer startup. And broadly speaking, this is a invite only program, but as part of Paytm Build for India, we try to give this opportunity to smaller startups, because generally, as of now, many of the brands are there, but we want to give the opportunity to smaller startups, and especially our founder Vijay, because he started as a small startup founder. So he wants to give this opportunity to smaller startups to be live on Paytm and do something big. So with that, I would like to start asking questions asked by people. So Shashank Agarwal has asked this question: difference between angel investors and venture capitalists. So this is also a common question which people ask in a lot of events. So can you tell about the differences?
Yeah. Angel investors typically are individuals or family offices who decide which company to invest in. They themselves decide which company to decide. So suppose at an angel network like ours, we put out 15 to 20 investment opportunities. You as an angel, Saurabh, may decide to only invest in 3 out of the 20 for whatever be the reason. Okay. So the individual has a choice, and he's investing his or her own money. A venture capital fund is basically raising monies from HNIs, from family offices, from institutions, from corporates, from development funds, and creating a pool. And then the VC managers, the managers of the venture capital fund, they are taking decisions into which companies would be invested. Hence, the investor of the venture capital fund, which I said are HNAs, family offices, institutions, etc., they are indirect investors in every company that the VC fund invests in. So there, the decision making has moved from the investor to the manager. That's the basic fundamental difference.
And these are SEBI registered in India.
Yes, yes.
So we have already covered this question. What are the basic things you look into a startup before investing? So just I will mark. So there is a question by Emmanuel that does Indian Angel Network support youngsters like me? So you can comment on the age profile of the founders and whether you are open to people just out of college.
Yeah, we are investing in youngsters. We like investing in youngsters. They have fresh ideas, they have energy, and they want to, they have ambitions. So that's of course there. We do invest in, we have invested in companies which are in founders which are not only straight out of college, but who have stepped out of college and set up companies. So we do that. I don't know how old you are, but yeah, happy to look at it.
Okay, and there is another question. Why do investors look at elite school founders? I think this is a very common question even in TAI. So why do you people prefer the elite colleges like IIT and IIMs for funding? So is there any reason of the quality of founders, or is it just due to the brand value of the school?
No, I think I would like to answer this differently and with all respect to the institutions that you mentioned. So I think one of the ways of assessing a founder's ability or competency rather is that if he is from one of the engineering colleges, top engineering colleges, there is a sense that he would have engineering competencies like, building products, building software algos. You sort of assume that he or she would have that. So that's one part of it. I think honestly, we don't look at entrepreneurs it's not a factor that we have to have people from these colleges. But what we have seen on the other hand is that the trend that we've seen with the data that we have, that the percentage of people stepping out of these colleges or institutions and starting up are much higher, right? So there is that trend which is not generated by us, but by these entrepreneurs themselves. Having said that, actually we've invested in companies and startups with founders who are even non-graduates. Okay. So it doesn't really mean that we only look at this. We look at people, we look at their passion, their potential, what they bring to the table, and what they can build.
Mm-hmm. So this
In
is
fact, there are some elite institutions I personally don't look at all.
oh. So this is a new revelation. I think many people have this.
Many people don't talk about it, I know, but I won't give you the name because otherwise I'll be killed in the ecosystem.
So another question which somebody is asking is, what are the major sectors in which Indian Angel Network invests?
We are sector agnostic. We are not finicky about sectors. We are looking at consumer behavior and market sizes. So fintech is very interesting. Unfortunately, Paytm is sitting here, but that's one of our big interests. Cyber security, agri-tech, edu-tech, online space is obviously very interesting today. The offline spaces we're looking at manufacturing tech. Okay, we're starting to look at biotech. We've done biotech, we've done health tech. We're starting to look at textile technology changes in textile hardware. We're pretty sector agnostic. But yeah, if you tell me, is that constant? No. As I mentioned, with the pandemic and the global situation, we are more aligned to consumer behavior and market requirements. Okay. That we sort of say, okay, for the next 3 years or 4 years, this is how we think from our research. We may be wrong, but this is how we've panned out the trends, and that's why we move into this. But one thing I must say, and it's a good, nobody's asked me this, but at IAN, over these last 15, 16 years, and going forward, we'll see this even more focused. We look at investing in companies that have a top line and a bottom line. At some point, we must be able to see them going profitable, turning profitable. We like companies which do, give us a sense of customer acquisition cost, unit economics, bill of materials. Those are nice things to tell us. Gross margin, those are good things to tell us. Just we are not in, we particular, nothing right or wrong. We particularly are not investors who invest in growth models only. We do like to see the old-fashioned bottom line also. That's just us. Purely, that's what we've seen. And more than us, I think it's our investor table that I'm sort of sharing.
Okay. So there is another question that basically what is preferable, bootstrapping or taking angel investment in the early phase?
Oh, I would be very, very clear on this. If you can grow your company without taking any external funding, debt, equity, please go ahead. The best way to build a company is revenues. There's no better way to build a company. So if you can avoid taking external funding, please avoid it. I know that means I may lose out on a good company or an investment opportunity, but I think it's very, very important that entrepreneurs build good companies for themselves. It's their business, it's their passion, it's their effort. If you can build it on your own and you think you're happy with that, go ahead. Absolutely go ahead. Best way to build businesses is your own revenues, company's own revenues.
Somebody has asked a question that do they have to be registered in as a company or under Startup India before approaching angel investors, or like as far as I know, there is no requirement, but can you tell?
No, so I think first there are two questions there. One is, do you have to register as a company? You have to become a company, only then can we invest, because investors take shares of the company. Do you have to register on a Startup India? You don't have to. But remember, why have we got that done? I've been pretty instrumental in getting that done. Is because there is an exemption to companies, startups which are registered at the startup certification from one section of the Income Tax Act, which avoids the angel tax if you raise money from angels. So my recommendation is that in future you will raise money from angels, right? And you don't want to go through tax issues, this is absolutely non-monetary, it's just an effort and it's a pretty easy job, you should. I don't see harm in doing it.
And basically,
We work very hard to get this done. So avail of it, startups, don't get yourself messed up.
so basically, people should incorporate as a company, or like somebody is also asking that I am incorporated as a partnership, and can I approach for raising investment, and only after raising the investment can convert the company to.
No, you can approach us even if you don't have a company, but we will only invest once you have a company and can issue shares to us.
Okay.
I mean, we can start discussions. That's quite okay. But we will only put in the money once we will only sign the shareholders agreement once there's a company. Otherwise, what am I signing?
So there is another question on, do you invest in non-tech founders? And this person is also asking that, do you need co-founders? Like many investors say that they only invest if there are 2 or more co-founders, or do you also invest in a single founder?
We do invest in non-tech companies. Wow Momo is a non-tech company, right? Which is into the food business. Bauxite is a non-tech company. Chakra is a non-tech company. Noka is a non-tech company. So there are enough for you to give you that. Look, we have invested in a single founder, but it's a rare. Okay, and let me tell you the logic. Why does, as I said, for investors, the biggest deal or the biggest collateral to invest in a company are the founders. Okay. Unfortunately, neither the entrepreneurs nor the investors nor anybody on this planet can guarantee that God will not have his way. What happens if a bus runs over the founder? The company comes to a grinding halt. The second thing that God has not done is given one person all the attributes to run a company, right? So 2 or 3 people at a co-founder level with complementary strengths makes for much better company. And it honestly de-stresses a single founder, right? Because early stage companies, startups, there's going to be more crisis. There are more lows than highs. That is the nature of the game. So you want somebody who's sharing your stress points.
Okay. So there is another question which somebody is asking that, do you can somebody approach you at the idea stage, or I would like to add a little bit to this. So do you prefer to have startups reach the product market fit stage, or do you invest at the idea stage or somewhere in between?
No, we do invest at prototype, product market, MVP stage. I don't think we would do it at the idea stage, to be very honest with you.
Okay. So basically, if somebody has a minimum viable product which they can, which they have basically validated a little bit in the market, they can approach you. And do you think that basically, if somebody wants bigger investment, they should have product market fit, or you are okay with people like raising bigger funds even without product market fit?
I think bigger funds, you 100% need a product market fit.
Okay. So I think we can ask one last question. So somebody is asking that, so this person has a sports startup. So specific, I think we can cover 2-3 industries. So is sports startup something which you can invest in? And somebody is also asking about fintech, which you have already told that fintech is one of the like best sectors which you look forward to. And I think fintech, sports, and 1 or 2 more, if you can tell about these sectors.
Yeah, so I think we typically invest if we can get an understanding of the space and the business. Okay, and every sector will have something which is specific to that sector. Okay, so for instance, if I do not understand nanotechnology, I'm not likely to invest. And I'm not playing Las Vegas here. I'm trying to understand the business and take a punt, right? So to me, sectors, I'm sector agnostic, but I'm not agnostic to understanding and comprehension, right? So we have invested in gaming. We haven't yet invested in sports, but doesn't mean we will not. In fact, we should. With Dream 11 getting IPL, there's no reason not to look at it, for example, right? We've invested in electric mobility. We've invested in electric vehicles. We've invested in semiconductor. We've invested in cybersecurity. We've invested in deep tech kind of deals. So we need to get an understanding, and the way we do that is, again, I don't know everything. I probably know very little, but do I have people within my network who can give me an understanding and saying, look, this is the space, this is where the gap is, this is where the value add is, and hold on, around the world, this is happening or not happening. Okay, that is what we need. So it's defined by our comprehension. And I would honestly tell entrepreneurs that when you're pitching, remember you're also educating investors. Don't assume investors know. They don't. Okay, the reason I like angel investing in early stage is because I actually learn from the entrepreneurs. They are my gurus in some ways, right? The way they think, the way the innovation happens, they think differently. And that sort of is very exciting for me. So I don't know everything. I think we are here to learn, we are here to understand, and then work with the entrepreneurs to make something out of it.
Okay. And one last question, somebody has just asked this question. And being a woman, you can answer this question. So do you think entrepreneurship belongs to women? And like today we hear about a lot of people getting funding, which are mostly males. So do women have that 50% chance in entrepreneurship? And when do you think that this ratio would become 50-50?
So I think there are two things. I would really like to state this very, very clearly, that at IEN, we are gender agnostic. We are person specific. Okay. So when we invest, we look at the person and the potential and the competency, right? The questions we ask of a woman are similar, maybe a different flavor to ask of a man. Okay, many people have asked me this question. Do you ask a question that what happens if you are pregnant? When you ask a lady, I ask the same question in a different way with a man. What happens when you have a child and how will you manage your family? Right? There are different perspectives to the same point. I won't even say issue. It's not an issue. It's life, right? These are things I think is not meant to be gender specific. These are issues of life which people need to understand. And I think that's a conversation that should be taken with an open mind. That's one part. The second part is whether women will get more money going forward. This is also embedded in our own social fabric over the centuries. As society, women are the home managers, right? And they've not been the bread earners traditionally. Life is changing very, very rapidly. Women have started going out and doing jobs. They've done these SOHOs, which I call small office, home office kind of situations, their own small businesses from home. In fact, a lot of women are the backbone of this country with these small businesses, right? And then you have the next level where they actually become entrepreneurs. And then you have the next level where they become investors, right? So women are changing, society is changing, and the role of women in society is changing. And that evolution is happening surely and quickly, but there is a lot of catch up that we want to do with the men. I think there is also, to be honest with you, this is not a question that is asked, and neither is it a question of investing. I think there is a societal change also happening in the men gender, right? They're having to look at a lot of things at home which they earlier didn't, right? To manage children, to sometimes even manage homes, to manage a lot of things that women do. So I think there is a societal change which is also impacting. Having said that, there are specific things to the gender of a woman and there's specific things to a gender of a man which play out, just the genetics. there women need help in some ways, and I must also say men also need in other aspects, right? They're rough, they don't understand sensitivities in some cases. There are issues of different kind of networking. Women have an issue, they are unable to network, to be honest, right? They need to be much more open, right? But they bring in huge multitasking capabilities. They bring in the empathy, they bring in the EQ. And today's world, in the knowledge world, where we are building ventures in the knowledge space, I think it's no longer a question of power. It's, physical power, that's gone. It's a question of IQ and EQ. And I think that's where the two should work together.
So it was nice having you in this webinar. I have personally learned a lot also. I believe that many startup founders would have learned a lot of things from you. And we look forward to having you in future for some other event. And it was nice to have you.
Thank you, Saurav, and thank you to Paytm for inviting me. Appreciate it.